Do churches make profits? What about other religious organizations like mosques? Do they make profits? Well, I think they do, but we do not refer to it as profits. Do they make losses as well? Yes, they do, possibly, but we still do not refer to them as what? As losses. What about other NGOs? NGO stands for non-governmental organization. So let's say Igalo Foundation, let's say Obafemi Martins Foundation, let's even say Noella Foundation. Now, do they make profits? Possibly, yes. And do they make losses? That's possible as well. But we do not refer to them as profits or losses. Why? Because they have not been established for the motive or for the purpose of making profit. So organizations that have been established without the motive or the major aim of making profit, we refer to them as not-for-profit making organization or non-profit making organization. So in this class, we'll be looking at accounting for not-for-profit making organization. Now, what I am trying to say is that any organization that has been established with other motives or other objectives other than profit making, that is, not basically to make profit but to render other services, we refer to them as not for profit making organizations. So we can be looking at maybe social clubs, maybe Koi Club or Lagos Country Club. Looking at NGOs, I already mentioned one, Noella Foundation, Igalo Foundation, Obafemi Martins Foundation, JAD Foundation, okay? And then religious organizations, churches, mosques, okay? So all these type of organizations that are established, okay, without the basic or the major aim of making profit is referred to as not-for-profit making organization, or sometimes referred to as non-profit making organization. Now, the account we prepare for not-for-profit making organization is usually in agreement with the going concern method, that is accounting that agree with the principle of double entry and bookkeeping procedures. So the same way we prepare accounts for regular organizations, that the same way we prepare for not-for-profit making organization. What I'm trying to say is that just like the way we use the principle of double entry and bookkeeping procedures to record the transactions and the activities of regular organization, that is organization that are meant for profit making, that's the same way we record the transactions and activities of not-for-profit making organization. Now, the major difference is that there are some terminologies that we use while preparing the accounts for not-for-profit making organization that are not the same with those of the regular organization or organization that are meant for profit making. So in a very simple form, what I'm saying is, while we use or adopt the same accounting principles and procedures to prepare accounts for non-profit making organization, there are some terminologies that we use that are peculiar to non-profit making organizations. Now we have accumulated fund. Now, if you are talking about a profit-making organization, you will say capital. That is maybe the owner's equity in the business or the resources of value that has been invested in the business at the beginning of the period or at the end of a particular period. So in terms of not-for-profit making organization, we refer to that as accumulated fund. So the build-up finance, okay, for not-for-profit making organization for a particular period is the accumulated fund. So the same way you build up finance for profit-making organization, I refer to it as capital. The finance you build up to operate or to begin a not-for-profit making organization, we refer to it as as accumulated fund. So basically, your total asset minus your total liabilities to external parties will give you the accumulated fund, of the organization at a particular period of time. The next one is surplus. Now, if you're talking about a profit-making organization, you'll be talking profit. Okay, but in a not-for-profit making organization, we talk surplus. So where your income for a particular period is more than your what? Expenditures or your expenses, we refer to it as what? As surplus. I'll say that again. Where your income for a particular period is greater or is more than your expenses or your expenditure for a particular period, we refer to it as what? Surplus. So in profit-making organization, we say profit. But in non-profit making organization, we say surplus. Now, deficit is the same thing as loss in profit-making organization. So what I'm saying is, instead of saying the organization made a loss, we say there was a deficit. So basically, the excess of the expenditure over the income for a particular period is what we call what? Deficit. So here we are comparing still the income for the period with the expenditure for the period. But in this case, the income is less than the what? Expenditure. So we say the business is at what? A deficit. Okay, now the next one is expenditure. So basically we have expired costs, what we call expenses in profit-making organizations. Okay, so in non-profit making organizations, we call them expenditures. Okay, so what you call expenses in the regular organizations, as the profit-making organizations, we refer to them as expenditures in not-for-profit making organization. Now, let's look at donations. Donation is one of the terminologies in non-for-profit making organizations. As a matter of fact, this is basically what most of the non-profit making organization depends on. Okay, so when you say willing contributions, okay, to non-profit making organizations, utilized to what? To manage the affairs of the business. That we call donation. But we have donations in different forms depending on the type of business. For instance, in churches, you can be hearing things like offerings, tithes, okay, project seeds, and all that. Okay, in social clubs, you'll be hearing things like maybe project sponsoring or project aids. Okay, you can be hearing pledges in churches. NGOs, you can be hearing things like aids. Okay, so the idea basically is that whichever form it comes, either in aids, in offering, in tithes, in pledges, or in sponsored projects, okay, we refer to them as donations in the not-for-profit making organization. So we can decide to as well name them as what we call subtitles. So we have donation, under donation we can have maybe for churches now, under donation you can have offering, tithes, pledges, okay, so as to have an easy recording and accounting. Okay, so but basically we refer to those willing contributions, okay, to non-profit making organizations, okay, as what? As donations. Now, subscriptions, this is a popular term, okay, even in profit making organizations. But before I get there, you can talk to those that are fond of going to social clubs, okay, let's say a Koi club, for instance. So as a member, there is usually what they call a regular fee or due that members pay to the organization. Okay, so we refer to them as what? As subscription. So periodically, members of certain non-profit making organizations pay dues, okay, to remain as members of the of the organization. So we refer to them as what? Subscriptions. So this is not only peculiar to non-profit making organizations. You can have subscriptions in what? Profit making organizations, like pay TV, for instance, your DSTV, okay, your Go TV. For you to be able to view some of those channels, you have to pay subscription. So those are profit making organizations, and they also use subscriptions. But in non-for-profit making organizations, you have some of them that also use what? Subscription. So basically, subscription is that periodic due or payment that members of the organization pay to remain or qualify as members of the organization. Now we have honorarium. Now basically as a non-for-profit making organization, it is possible to have some services rendered to the organization, okay, by individuals or even members, okay, but that service is not binding or legally binding the organization to be paid for. What I'm saying is there's some services that are rendered to the organization that the organization is not legally binded or legally held to pay for that service. But in order to honor the person that rendered such service, the organization pays certain stipend or certain amount of money in a way of saying thank you to that person. So basically, you're trying to honor that person for the service rendered to the organization, even though you are not legally committed to pay for such service. So we refer to such sort of arrangement as what? As honorarium. Okay, a payment made to the an individual who rendered the service to an organization that the organization is not legally committed to pay for. Okay, that is what we call honorarium. Now, receipts and payment, as the name implies, as a non-for-profit making organization, you should have, you have activities, you have transactions. So this transaction can either bring in cash or take out cash. Okay, so you can have your cash in the office, you can have your cash in the bank, whichever way, cash is cash. Okay, but the idea is that you can have cash coming into the business and you can have cash going out of the business. So the account that records cash coming into the business and going out of the business, okay, it's what we call receipt and payment account. In your profit-making organization, we refer to them as what? As cash book. So what you call cash book in a profit-making organization, you call it receipt and payment account in a not-for-profit making organization. So the principle remains the same thing. All your cash receipt is debited and all your cash payment is credited. So basically, you want to know how much is left after spending out of the cash that the business has for a particular period. So this is what it looks like. Okay, you have receipt and payment account for 31st 2010. Okay, so we have the debit side here is for receipts, we have the credit side here is for payment. So balance report is the opening balance you have in the cash account or in the bank account. Okay, you can have 1 million, you can have 2 million, you can have 3, you can even have 4 billion. That's the balance report. As at the beginning of the year, you have this. So whatever cash you receive, again, maybe you sold goods in cash, or you sold some items, okay, to members in cash. It's a cash sales that is flowing in. So you have your receipt here. Subscription that you receive from members, you have cash receipt here. Donations that you receive from members, you have it here. So basically, all the cash receipts you debit, and whatever payment you're making, salaries, you credit. Transportation, honorarium, you buy furniture, you buy equipment. Whenever you're spending out of the cash, you credit. Whenever you receive cash, you debit. That is what we call receipt and payment account. Debit side is for receipt, credit side is for what? Payment. So at the end, you want to know how much is left. So what do? Compare the total receipt with the total what? Payment. So whatever you have here, you compare to whatever you have here. So if your total receipt is say 2 billion and total payment is say 1.5 billion, then you have 500,000 naira left. 500 what they call 0.5 billion, okay, left in the cash. So what I'm saying, for instance, for the sake of argument, let's bring it down a bit. What I'm saying is, if you have cash receipt of say 100,000 and you have cash payment of say 80,000, okay, so it means that out of 100,000 you have spent 80,000, and what is left? 20,000. That is the balance you have in the account as at the end of the of the period. Okay, so that is the point I am trying to make. So you can just do your own little arithmetic on your own. Use very simple figures so you understand what I'm trying to say. So basically, you got some money and then you paid some out. How much do you have left? That is what you have as balance carried down here. So basically, we have added 1, 2, 3, 4, And then we'll now add 1, 2, 3, 4, 5. So whatever we have as total here, take it out of the total here. That's what you have as a balance carried, and that is what you have left unspent at the end of the period. So both sides becomes what? Equal. The balance carried down becomes your balance brought down here in the debit side. So now we have income and expenditure account. Okay. So what I am trying to say here is that you are looking at what? Profit and loss. So basically, in a regular organization, you're saying profit and loss, okay? But in this not-for-profit making organization, you're saying income and what? Expenditure. So what are the earnings for the period and what are the expenditures or the expenses for the period? So when you compare your earnings with your expenses, you show them in what? In your income and expenditure what? Account. So basically what I am saying is that the account that shows the earnings of the organization vis-a-vis the expenditures or the cost incurred or the expenses incurred for the same period is what we call the income and expenditure account. But in a regular organization, which is your profit-making organization, you refer to them as what? Profit and loss account. So basically your income is credited while your expenditures are what? Debited. So what's the essence? You want to know if you have a surplus or you have a deficit. What's a surplus? Your income is greater than your what? Expenditure. That is a surplus. But if it's a deficit, your income is less than your what? Expenditure. Just like what you have in a regular organization, you do what they call profit and loss account. So you either have a profit where your income is higher than your expenses, or you have a loss where your expenses are higher than your what? Your income. It's the same thing, but in not-for-profit making organization, we refer to the account as income and expenditure instead of profit and loss. So what we derive is what they call surplus instead of what? Profit, or deficit instead of what? Of loss. So here is what it looks like. Income and expenditure account. So we have what it looks like. So the income and expenditure account for the year ended at 2010. So your debit side is for your expenditures, your credit side is for your what? Incomes. Okay. So what are the incomes? You can have sales, you can have subscriptions, those are your incomes. Donations, those are your incomes. Then what are your expenses? You pay salaries, you pay transportation, you pay honorary, you pay for any expenses that the organization has incurred for the what period. So at the end, you want to know if you have a surplus or a deficit. So what's a surplus? Your income, which is the credit side, is higher than your what? Your expense, which is the what? Debit side. So this is a surplus. If it's a deficit, then that means your expenses are higher than your what? Your incomes. That is what we call the income and expenditure account. Now, alternatively, we can prepare the income and expenditure account in this form. You have income and expenditure account for the year ended at 2010. So basically, what are we trying to compare? We're trying to compare our income with our what? Expenditure. So what do you say? You have incomes. Note 1. Note 1 will show you the items that made up your what? Your incomes. You have expenditures. Note 2. Note 2 will show you items that make up your what? Expenditure. So note 1 here. Look at note 1. Sales, subscription, donation. When you add them up, whatever you have, you bring here. So what makes your expenditures? Note 2, salaries, transport, and whatever makes up your expenditures, you add them up and then you bring them here. So your income minus your expenditure will give you your what? Your surplus. So don't forget, if your income is higher than your expenditure, is surplus. If your expenditure is higher than your what? Income, it is what? Deficit. But from this format of what we're trying to show you here, the income is higher than the expenditure, so we have what? A surplus. So I here is income, E here is what? Expenditure. So you can do it this way or you do it the other way. Now it is possible to think that the receipt and payment account is the same thing as the income and expenditure. Okay, so it looks alike, but they are not the same thing. So we have what they call similarities and differences. So let's look at some similarities. So here we have both account recording income and expenditure items. Basically, your receipt and payment is cash receipt and cash payment. So subscription that you receive from what? Members is a receipt. When you pay salaries is a what? Is a payment. So you have it in what? In the receipt and payment account. So the same way, your subscription received is an income, salaries are what? Is an expenditure. So you can see that the same item, you have it in what? In receipt and payment account, you have the same item in what? Income and what? Expenditure. That's a similarity. Okay, and then another thing is that both accounts are prepared for specific periods, okay, depending on the objective of the accountant. What I'm saying is this: if, for instance, maybe in the first quarter, which we would normally call Q1, okay, you want to know how much you received from what activity. So you can prepare a receipt and payment account, okay? That will show you how much you have received. You can also decide, okay, you want to know in that Q1, you want to know how much balance you had after taking out the payment from the receipt that you got. Okay, let's assume you received in cash, say 1 million, and then you spent, let's say, 800,000. So that means you have a balance of 200,000. So if you want to know that value that is remaining at the end of a particular period, you prepare your receipt and payment account. The same thing you can do to your income and expenditure. You can say, okay, for that same Q1, I want to know what the surplus or deficit looks like. So basically what I'm trying to say is that it is a similarity to say, okay, that the receipt and payment account can be prepared for a particular period. So also the income and expenditure account. So this is at the what they call the prerogative or at the beck and call of the accountant or whoever is preparing the account, depending on what the person wants to achieve at that point in time. So these are basically the similarities between receipt and payment account and income and expenditure. So let's look at differences, okay? The first one here is that the receipt and payment account is more of a book of account. Yes, that's true. Just like your cash book. Your cash book is not the same thing as your profit and loss account. So your receipt and payment account is like a cash book. Income and expenditure is like profit and loss. So they are both different. One is like a book of account. The other is like a statement. Okay, the next one is that receipt and payment account has a different objective. That's sure from the income and expenditure account. The objective of a receipt and payment account is to know the cash received vis-a-vis the cash payment. So you want to know how much is left at the end of a particular period. But income and expenditure will tell you if you have made a deficit or if you have made a surplus. Receipt and payment account is a daily transactional record. What I'm trying to say is that because of the fact that you are recording cash inflow and cash outflow, so you can be receiving cash on daily basis. As you receive it, you record it in the receipt and payment account. As you pay, you record. But that is not the case with income and expenditure. Income and expenditure account is a periodic statement, but your receipt and payment account is something that you should be able to go to every day based on on transactions. So if you're receiving sales every day, you'll be recording the receipt and payment account. But that's not what you do in income and expenditure. Receipt and payment account is part of a bookkeeping process. That's true. What are your bookkeeping process? Identify your transactions, okay, enter them in the books of accounts, extract your ledgers, balance your ledgers, prepare your trial balance. That's a bookkeeping process. But income and expenditure is more of an accounting and reporting process. Out of the trial balance, you now prepare your income and expenditure and your balance sheet. Okay, so you have receipt and payment being part of the booking process. Why income and expenditure is more of a reporting process. So another item, the items like purchase of fixed assets. When you buy fixed assets, you record them in your receipt and payment because you're going to pay cash. But you cannot record fixed assets in your income and expenditure. Remember, fixed assets are balance sheet items. It's the same thing in this type of organization. Now we have non-cash items. Depreciation, okay, is not a cash item. You can't record it in your receipt and payment, but depreciation will go to your income and expenditure because you're reducing your fixed assets. And that part that you're taking off or yanking off of the fixed assets is treated as an expense. I already taught us depreciation. So it's the same application. So it is not a cash movement item. So you can't take depreciation to your receipt and payment, but it will definitely go to your income and expenditure. Okay, now this is an illustration on how to prepare receipt and payment and income and expenditure. So you will say the following records were gathered from the books of Hawks Club Lagos for the year ended 31st December 2009. We have cash balance at 1st January 2009. That's opening cash balance. 450,000. Sales of party ticket. When you sell party ticket, you receive cash. Subscription received from members, you receive cash. Rent, you pay. Transportation, you pay. Honorarium, you pay. Cash paid for furniture and fittings, you pay. Cash paid for equipment, you pay. Cash paid for motor vehicle, you paid. Cash paid for motor vehicle expense, you paid. Cash paid for equipment repairs, you paid. Donation received from members, you receive cash. Building project aid, you receive cash. Salaries, you paid. Public relations, you paid. Staff training, you paid. Communication expense, you paid. So they're not saying you are required to prepare the receipt and payment account and income and expenditure account for the period. So we already know that our receipt and payment account is what? To record cash receipt and cash payment. So basically, what do you say? Hawks Club Lagos. Receipt and payment account for the year ended 31st December 2009. So what is the balance brought forward? The balance brought forward is the opening cash, okay, at the beginning of the what? Of the period. So here we have cash balance at our 1st January 2009, 450,000. That's the balance brought forward here, 450,000. Remember, your debit side of the receipt and payment is for receipt. Credit side is for what? Payment. So all the receipts you debit, all the payment you what? Credit. So what are all the what? Receipts. We have sale of party tickets. Look at it here, 800,000. It's in the question. Subscription received from members. It's in the question, 1,365,000. Donation. Where's the donation? Donation received from members, 590,000. You have it there, 590,000. Building project aid. Okay, aid like contribution for building project. So that's a receipt. So how much is it? 2.5 million. So we have building project aid, 2.5 million. So those are the receipts. So what are the payments? You check out the question. What are they? We have rent. Rent is 250,000. Transportation, 250,000. Honorarium, 230,000. Cash paid for furniture, 220,000. Cash paid for equipment, okay, 85,000. Cash paid for motor vehicle, 320,000. Cash paid for motor vehicle expense, 35,000. Cash paid for salaries here. We have question said 269,000. You have salaries at 269,000. Cash paid for public relation, 85,000. Cash paid for staff training, 38,900. Cash paid for communication expense, we have 18,500. So basically, we have all the receipt items, we have all the payment items. So when you add up all the receipt item, you minus all the what payment item, you have a balance of what? 3,878,600. Use your calculator. Okay, add up everything here, add up everything here. Take out the total here, from here, you have this balance. 3,878,600. That to tell you that at the end of the year 2009, you had 3,878,600 left out of what the cash you received after making what payments. So that means you have balance carried down, that becomes balance brought down here. That's the receipt and payment account. So the next one now is what? Income and what? Expenditure. We already know that our income and expenditure is a function of what? Your incomes and your expenditure. So basically, we want to know if you made what? A surplus or what? A deficit. So what are your incomes? You have your incomes. Note 1. So what are the things that made up your income? You have sales party ticket. It's in the question. Sales party ticket, 800,000. Okay. So we have subscription received, 1,365,000. Is in the question. We have donation received. Donation received is 590,000. So when you add everything, you have 2,755,000. That's what you have here. 2,755,000. So what are your expenditures? Your expenditures in the question. Look at it. We have rent. We have rent here. Remember your expenditures. They are same as your expenses. I've taught you profit and loss account before. It's just like your expenses. So we have rent, 250,000. Transportation, 250,000. Honorarium, 250,000. Motor vehicle cannot come there because motor vehicle is a fixed asset. It's a balance sheet item. So you can't put it in expense. So you leave it. Okay, if we were preparing balance sheet, we'll take that one to what? To balance sheet. But we are not preparing balance sheet. We're preparing income and expenditure. So you only take your expenses and your incomes. So motor vehicle expenses will come there. Cash paid for motor vehicle expenses, 35,000. It will come there. Okay, motor equipment, we have what? Cash paid for equipment repairs. Yeah, repairs are expense. It will come there. Salaries is an expense. It will come there. Public relations is an expense. Okay. Look at the question. Public relations is in the question. Have you seen it? 85,000. So we have 85,000. Staff training is in the question. 38,900. Communication expense is in the question. 18,500. So we only picked the expenses. You can't pick a fixed asset and put it in income and expenditure. Okay. So when you add up everything, you have 1,201,400. That is what is your expenditure here. So when you minus the expenditure from your what income, you have a surplus of 1,553,600. So basically, there's a surplus because your income is higher than your expenditures. So in this class, for not-for-profit making organization, we're able to define what a non-profit organization means, and we look at terminologies, we look at similarities and differences. We also look at how to prepare receipt and payment and income and expenditure account. We look at the differences and similarities between receipt and payment and income and expenditure account. And then we have an illustration to prepare them. So join me in the next class for subscriptions and adjustment in terms of prepayment and accruals, and then how to prepare the balance sheet for not-for-profit making organizations. If you have questions, you can reach me on 08136506356 or send me an email, jeremiah.doso@gmail.com. Drop questions in the comment section. I'll be there to reply you with the right answer. Don't forget, join me in the next class for subscriptions and preparation of balance sheets. We'll also be looking at prepayments and accruals as affect subscriptions and other income and expenses of not-for-profit making organization. Thank you.